Today, we are excited to be exploring tax updates for cooperatives with Bill Scott. Bill is a principal in the Ag, Food, and Beverage Industry Group specializing in tax planning and compliance. With over 13 years of experience at Clifton Larson Allen, he serves is the Western Ohio Food Office Ag, Food, and Beverage Industry Group leader. Industry practice areas include cooperatives, producers, and manufacturing and distribution. Bill is a leader on Clifton Larson Allen's National Cooperative Tax Team and leads monthly team calls to discuss cooperative related tax topics. Bill is a frequent speaker on tax reform and other tax related topics, including industry specific conference breakout sessions and seminars. So we are going to welcome Bill. Bill, thank you for joining us. And let me stop sharing my screen so you can share yours.
Sure. Thanks for having me.
And there you go.
Share my screen real quick. Let me know when you can see that.
I can see it. It's not on your welcome slide though.
Yep.
I don't. Okay, there you go.
Perfect. Awesome. Thank you. Well, I appreciate inviting me to talk everybody's favorite topic today, income tax. Excited to be here. When we originally talked about putting this session together, the plan was to discuss provisions in the Tax Cuts and Jobs Act that were set to sunset at the end of this year. I don't think anybody back in April or May when we originally discussed this thought the tax bill would actually get passed by the 4th of July. But President Trump got his way and we actually got a tax bill. So pivoted a little bit and put together a presentation to talk through the key provisions in the One Big Beautiful Bill Act. From now on, I'm just going to refer to it as the tax bill, so I don't have to keep trying to say that tongue twister. And when I refer to the old tax bill, I'll just refer to it as the TCJA, which stands for Tax Cuts and Jobs Act. So hopefully that doesn't get too confusing, but that's kind of the easy way to refer to the two tax bills because we kind of go back and forth a little bit here on some of the slides. So I appreciate the intro. I won't spend too much time adding to that, but as Ann mentioned, I'm a tax principal with CLA. I sit in our Northwest Ohio office. We're in Maumee, Ohio, which is a suburb of Toledo. And I've been serving co-op clients for the majority of my career. I serve clients really all across the country, heavy in the agricultural space, but also serve several co-ops in non-ag industries as well. So happy to be here and excited to talk the One Big Beautiful Bill. So with that, this first slide, this is just something the firm requires me to put in there. Basically what that says is nothing in here is to be taken as tax advice. Please consult your tax advisor. Don't sue me. Don't sue CLA, please. So quick agenda. Throughout the presentation, we'll kind of just give an overview of what the Tax Act is all about. It's a 900-page bill, so this is very high level. There's a lot in there that won't be addressed in this. So really I'm trying to hit on, kind of the key provisions in here, specifically as it pertains to cooperatives. I will hit on the big individual provisions as well as it's going to affect everybody in this room and employees at the co-ops and whatnot. But really we'll key in on the business provisions that are going to affect the co-op specifically. So we'll start out with key tax law changes as it pertains to businesses. As I mentioned, it's a huge tax bill. If we put everything in here, we'd have all day and probably still wouldn't cover everything. So there's likely going to be some things in here that don't cover some issues that maybe you had questions on. So trying to save some time at the end to answer questions. Hopefully I can address those. Done quite a bit of a deep dive into the bill, but I'm sure there's still plenty in there that I still need to educate myself on. So I'll do my best to answer as many questions as possible at the end. And then, the other caveat is, as with any major tax bill, there's still a lot of guidance to come. So what's in here could be, some of the things in here could be obsolete tomorrow, could be obsolete by the time we get off this call. Likely there's a lot of guidance coming specifically on some issues like the no tax on tips and overtime. There's a lot of questions on that. So do our best to explain as we understand the bill as it is today, but just know that down the road some of the interpretations of what's in the bill here could change based on, guidance. We have been promised some guidance within 90 days of the passage of the bill, which, is, we're, I guess, about halfway through that period. So over the next month or two, we should hopefully start seeing some more specific guidance, but we'll see where that goes. As everybody knows, I'm sure the IRS can be very slow to move. So I wouldn't get too excited about anything too substantial over the next couple of weeks. So first slide I'm going to jump into, like I said, this has probably been the number one thing we've gotten the most questions on. A lot of questions on how this is going to work. What does it mean for my business? What does it mean for employees? So during President Trump's presidential campaign, one of his big campaign promises was he was going to eliminate tax on tips and overtime. So they did put something in the bill that essentially gives an above the line deduction for employees who have income that is considered qualified tips and overtime. There's income thresholds that you have to meet in order to qualify for that deduction. And there are some, I guess, some caveats that aren't maybe necessarily communicated great in the media. I think people hear no tax on my overtime. They think, okay, I'm not going to pay payroll tax. I'm not going to pay any income tax whatsoever on any time I work over 40 hours. And that's really not the case. So payroll taxes continue to be, withheld and remitted with no change. So there is payroll taxes on those wages. And really for the overtime piece, it's really only the premium pay that an employee receives when they work overtime. So if you have an employee that works 50 hours, they get time and a half for that 10 hours of overtime they worked. The credit would be based on that half piece, not the full 10-hour pay. It's really just that half premium pay that they got for working the overtime. So as an employer for the business itself, not a whole lot changes as far as, reporting and whatnot. There's going to be, since this is retroactive to 2025, there could be a little bit of a lift in the first year. Assuming you're working with a, qualified payroll provider, they should have all the information you need. Still some guidance to come out about how this is going to be reported, but likely there's going to be some sort of reporting mechanism on the W-2 where you give the employees what their qualified overtime pay was so they can take that deduction. And then on the tip piece, I'm not going to spend a whole lot of time there since likely not very applicable to people on the call here. But again, it'll be reported on the W-2, and there's some interesting things in the bill. For example, it only voluntary tips are qualified. So if you think about, you go to a restaurant and you have a big group and they have that mandatory 18% gratuity on that bill, that's likely under the current interpretation of the bill that likely doesn't qualify because that's not mandatory. So there's some interesting things in there that they still need to work out. But we can answer. Like I said, I've had probably more questions on this than anything else in this bill. So if there's anything I didn't address, we can certainly discuss that at the end when we open it up for questions. The other thing on the slide here is they did increase the 1099 reporting threshold from 600 to 2,000, and that takes effect in 2026. So this year, 2025 reporting on 1099s will be the same as before. And then that will, in the future, it will start to be indexed for inflation, which has never really been the case. So now I'm going to kind of switch gears and jump right into, I guess, what we call, the big three provisions in this tax bill. The first one is research and development expensing. You may recall that back when they passed the Tax Cuts and Jobs Act, they added one of the revenue raisers in that tax bill was that starting in 2022, if you had research and development costs, you could no longer expense those in the year incurred. You had to capitalize them and amortize over 5 years, or 15 if you have foreign R&D expenses. So for a few years there, you'd have a big add back, depending on how much R&D you had. It could be potentially a big add back, and then you would depreciate, or you'd amortize that over the next 5 years and take the deduction. So it was really a timing difference, but it was a pretty significant hit for businesses with significant R&D. The original intention was to pass a future tax bill that would essentially eliminate that, or at least kick the can down the road. They did originally try to pass a bill. There was a tax bill on the floor in the year of the presidential campaign, but due to politics and the fact that it was an election year, that bill never got passed. So we did end up having 3 years of capitalized R&D expenses. Again, pretty big tax implications for businesses that had a lot of R&D. So one of the great things in this tax bill was we're back to full expensing in the year incurred for domestic R&D. It does not get rid of the 15-year amortization or 15-year capitalization period for foreign R&D, but at least we're back to full expensing of the domestic. And there's 2 options to unwind the prior year capitalized expenses. So you still have, if you've capitalized in 2022 through 2024, if you qualify as a small business and they've reset the threshold for small businesses to be under 31 million of gross receipts, average over the past 3 years, you do have the ability to go back and amend and get refunds for those years. If you're not a qualified small business, you just have to wait until 2025 and you can deduct those expenses. Any unamortized R&D expenses can be deducted in 2025 or ratably over 25 and 26. So you do get to undo it. But if you're not a small business, you can't just go back and amend. And I guess just a note on that is as we started doing some projections and modeling for some of our clients that do qualify to go back and amend, we actually determined that, in many cases, that's not necessarily the best answer, just given the extra compliance, the cost that it takes to go back and amend returns. And then the IRS is notoriously slow for processing amended returns and sending out those refunds. So in some cases, even if you qualify for the amended, it might make sense to just wait until 2025 and take those deductions. So planning opportunity, obviously, if your business has research and development costs and you've had to amortize over the past several years, make sure you're taking that into account for your tax planning for 2025, since you'll likely have a larger than anticipated deduction from what, beginning of the year projections were or tax planning from last year. If you have an income tax provision, likely you're going to have a pretty big deviation from what was booked in, quarterly projections. If you have, if you're paying estimates on a quarterly basis, the first couple of quarters likely are higher than they needed to be because you're going to have a pretty big deduction that's going to flow into the year that wasn't there under previous tax law before the passage of the tax bill. The other thing is this makes R&D credits much more valuable again. Not that they weren't valuable under the Section 174 capitalization period, but companies were a lot more hesitant to really dig in and see if they qualified for the R&D credit because, they knew that along with that, they could also unearth Section 174 costs that would have to be capitalized. Now we go back to pre-2022 rules where you get to deduct those costs in the year incurred and you take the credit. So much more beneficial with the R&D credit because you don't have that corresponding pickup in taxable income for those costs. Next thing, and this is probably the biggest thing in here that's going to affect the vast majority of businesses and likely everybody on the call. So the tax bill reinstated 100% bonus depreciation. Bonus depreciation has been around for quite a while now and under several different iterations. And there's always been different phase out periods, and then they bring it back in a future tax bill. What's big in this tax bill is they finally made it permanent. And as we all know, permanent only means until there's a future tax bill that unwinds it, but at least there's not a phase out period where this is just going to go away without being extended or reinstated. So until they pass another bill that gets rid of bonus, this is a permanent tax strategy. And what bonus depreciation is essentially lets you expense up 100% of the cost of property in the year acquired. Generally, that's going to be anything that's not real property. There's a few exceptions there, but generally, equipment, land improvements, things like that. You can take full 100% bonus expensing. And that's for any assets placed in service after 1/19/2025. That might seem like a weird arbitrary date to pick, but the significance of that date is that it's any asset placed in service after inauguration day, which is why that was placed. So this is one of the few things in the bill that has a specific date where it takes effect. Most everything else is either, calendar year 25 or 26, depending on what the provision is. This one has a very specific date. One new thing they added, and this is in addition to what we had with previous 100% bonus expensing, was qualified production property. This could be, for businesses that are manufacturing and producing products here domestically. This could be a huge tax planning technique. So I mentioned buildings generally don't qualify for bonus depreciation expensing. Under this qualified production property, if you have a new manufacturing facility, you can actually take bonus depreciation on the portion of that facility that is used specifically for manufacturing. So in order to take that deduction, you're likely going to need a cost segregation study, which I can talk about in more detail if you need information on what that is. But essentially what that is, you take a look at all the components of a building, and you can pull out different pieces that are, outside of the normal structure of a building and depreciate them at a shorter life for tax, which also makes them qualified for bonus depreciation. Historically, generally, you can pull out somewhere between 20 and 30% of the cost of a building. Under the qualified production property rules, you could likely pull out a much larger portion of the building under a new manufacturing facility. But the reason you would need a cost seg study to substantiate that is it is specifically only for the manufacturing portion of the building. So assuming you have a break room and some offices, you have, a parking lot, things like that. Even though those are kind of small pieces of the overall building, those aren't going to qualify for this deduction. So you have to really break out those components to substantiate what's going to qualify for qualified production property. And then Section 179, again, this is just another form of accelerated depreciation. The thresholds for that were increased to $2.5 million after 12/31/24. So just an expansion of Section 179. There are some different reasons why you would want to take bonus versus 179. For federal purposes, you kind of get to the same answer. Section 179 does have some limitations where you can't create a loss with Section 179, but you also have more flexibility in that you can pick and choose what assets you're going to fully depreciate. Whereas when you take bonus, you have to take it on the full. So let's say you're taking bonus on 5-year property. It has to be on all 5-year property. You can't just select single assets. So if you qualify, if you're under the threshold for 179, you do have some flexibility. And also, for whatever reason, some states have been more willing to conform to Section 179 rules versus bonus rules. So there could be a state benefit to taking Section 179 versus bonus. And then just another thing to note, as far as state income tax goes, it's important to monitor state conformity for these new bonus depreciation rules. States have been notoriously slow to conform to new federal tax law. So even if states that you're operating in have conformed to bonus depreciation rules under past tax bills, for example, the Tax Cuts and Jobs Act, it's not safe to just assume that they've conformed to the new rules. So unless they update their tax law, they're likely still under, the 40% phase out limitation that was in effect for 2025 prior to the passing of this bill. So just something to take a look at, keep an eye on, especially if you're in multiple states. Some states will be real quick to either say, yes, we conform, or no, we don't. And some others might drag their feet. So, you might even have to extend some tax returns while you wait and see what they're going to do. But make sure you keep an eye on state tax implications as it pertains to the new bonus depreciation rules. And again, I already mentioned cost seg studies. So in addition to the qualified production property, this just makes cost seg studies that much more valuable. Not that, they were very valuable regardless, but going back to 100% bonus depreciation means that if you do a cost seg study, even if it's not a manufacturing facility, not something that's going to qualify for that QPP property, you can still pull out, let's say you pull out 20% of the overall cost of your building, and now that qualifies for 100% bonus. That's a pretty big deduction that you get to pull forward as opposed to depreciating over a 39-year period. So it's really a time value money play. but it can be pretty substantial. And when you look at the time value money benefit of doing these cost seg studies, it can be pretty significant, especially when we have 100% bonus depreciation. The third of what I would call the big three in this tax bill is changes that they made to the 163J business interest limitation. And what this was is, so back when they passed the TCJA, they added a limitation for how much businesses could deduct from their interest expense. So previously, you could deduct all your interest expense, really no questions asked. Under the TCJA, you were limited to 30% of your adjusted taxable income. So one of the adjustments initially was that you got to add back your depreciation, amortization, and depletion expense. So even if you had zero taxable income, if you had $1 million of depreciation expense, you would get to add that back. So your threshold for your business interest deduction would be the $1 million. So you'd be able to deduct up to $300,000 of interest expense. Starting in 2022, they took away that add back for depreciation, amortization, and depletion. That was a revenue raiser in the Tax Cuts and Jobs Act, just to make the numbers work for when they passed the bill. They had to find ways to, kind of claw back some of the savings to make sure that they passed a balanced bill. So that's why that went into effect. The original plan all along was to, again, fix that similar to the Section 174. But again, they were never able to pass a tax bill. So we had several years where you could not add back your depreciation expense for that limitation. If you think about what else has happened since 2022, interest rates have gone way up. We were at, very low interest rates when Tax Cuts and Jobs Act originally was passed. So not a lot of businesses were really affected by this. And then 2022, we lose the ability to add back our depreciation expense. Interest rates go way up. And then I know there's some agricultural cooperatives on the call. A lot of my ag co-ops, especially, the grain co-ops, you see the grain prices started going way down compared to, some big years coming out of COVID. So you had grain prices going way down, interest rates going way up, and losing the ability to deduct or add back your depreciation. So this 163J limitation was pretty significant for a lot of businesses. So getting back the ability to add back the depreciation really should increase that threshold again, and hopefully provide some relief to companies that were subject to this limitation and have significant interest expense carry forward. So just a reminder, if you were subject to these limitations, you don't lose the expense. It just carries forward to a future year, similar to a net operating loss. But you can only use it in a year in the future where you're under that limitation threshold. So if you're continually hitting that threshold, you're just increasing your limitation year after year. So by increasing that threshold, hopefully less companies are subject to these limitations, and hopefully we see a lot of that interest expense carry forward start to get relieved and able to be deducted against taxable income. And one thing to note, this is very specific, but there may be a few people on the call that this pertains to, so I want to point it out. Due to those limitations, starting in 2022, there was sort of a workaround where you could make an election under Code Section 266, and I don't want to get super technical in the weeds here, but basically what you could do is you could elect to capitalize a portion of your interest into your inventory costs and run it through your cost of goods sold. And that was kind of a workaround to get it out of that 163J limitation. So depending on how fast you're turning inventory, there's a way to deduct that interest expense quicker. In the new tax bill, they did address that, and they updated their ordering rules. And now starting in 2025, 163J comes into effect prior to any capitalized interest. So capitalized interest is no longer going to be excluded from Section 163J. So again, planning opportunity. If you had some, disallowed interest expense in a prior year, and you have a lot of depreciation expense, likely you're going to have a much larger interest expense deduction starting in 25 than you did in the past. So again, make sure when you're doing those quarterly estimates, modeling, doing tax planning, make sure you're taking into account that that higher threshold, because it could have potential significant impact on your taxable income for the year. And then the other thing to point out is that there is an election that certain businesses, including agricultural co-ops, are allowed to make that allows you to opt out of Section 163J. There's some stipulations that come with that. The big thing is that you can no longer take bonus depreciation on certain assets, and you have to depreciate them over longer lives. I've been hesitant to make that election for clients, even when they have been subject to 163J, because that election's irrevocable. And as of right now, there's no relief for revoking that election if you did make it. So I know several businesses decided to make that election once they started getting hit with significant limitations. So unfortunately, even though the tax law changed and maybe those limitations aren't as severe, or maybe they're not there at all anymore, as of right now, there's no relief to revoke that election. So unless the IRS comes out and says otherwise, you're kind of stuck with that election. And then this was another big, so the Tax Cuts and Jobs Act, most of the corporate tax provisions were permanent, but there were a few things that were set to sunset. The big one was the 199A deduction. That's the 20% pass-through deduction on business income. They kind of passed to basically level the playing field for lowering the corporate tax rate to 21%. But why this is important for co-ops, if you're an agricultural co-op that qualifies for 199AG deduction, 199AG is basically married to the 199A deduction. So they not only reinstated 199A beyond 2025, they actually made it permanent. So that effectively makes the 199AG deduction permanent as well. Huge win for ag co-ops that take advantage of that deduction. I have several clients that have just huge 199AG deductions, and it's a huge benefit to their business. The co-op community did a great job of lobbying for this. We had several clients reach out to help them tell their story, whether it was through NCFC, NSAC, several other national co-op groups. But the co-op community really came together to lobby for this and make sure that it made it into the final bill, and thankfully it did. Not going to get into too much detail on the clean energy credits. Just wanted to point out that some of the credits did get either diminished. There's some phase outs for some credits. A lot of the EV vehicle credits are going to be phased out or terminated early. There's some new restrictions around foreign entities of concern to make sure that, I think China, Russia, the typical countries that you think of when you hear that phrase, to make sure they're not taking advantage of green energy credits here in the States. So again, not going to get into too much detail on those, but if you are taking advantage of green energy credits, to make sure you're working with your tax advisor to see, are the ones you're taking advantage of going to phase out? If they are, do you need to accelerate any projects, or make sure that you take that into account in your planning? One big win though. So originally there was talk of fully repealing the Inflation Reduction Act. That didn't end up happening. And there haven't been any changes to transferability. And again, this is probably something that may affect a handful in the group, maybe not affect anybody. But essentially what the Inflation Reduction Act did for the first time was allowed businesses to basically go out on the open market and buy and sell these green energy credits. So if you're think of a startup business that has a huge solar investment, but they don't have any taxable income and likely won't for several years, they might generate this huge credit but never be able to use it because it's just going to sit there and wait for taxable income. On the flip side, you have big company that generates a lot of taxable income. They don't necessarily have any investments themselves, but now they can go out on the marketplace and buy these credits from companies that are willing to sell them. So generally speaking, you see those credits go for 90 cents on the dollar, give or take. And then the spread between what you paid for the credit and the benefit you received is not taxable to the business acquiring, and the cash received is not taxable to the business that sold the credit. So there's been no changes to the transferability. So if you happen to be taking advantage of that, should be in the clear, at least for now. Again, here's just a little more detail on some of the credits that had some changes in the provision. Energy efficient commercial buildings deduction, the section 179D is repealed for projects that begin after 6/30/26. New energy efficient home credit, same thing. So again, just be aware if you're taking clean energy or green energy credits, just take a look at the ones you're taking advantage of and see if there's been any changes. And just a couple other business provisions to point out. The first one, Section 1202, likely not not applicable to cooperative businesses, but essentially what that is for small businesses, if you're selling your business, there could be a potential opportunity to exclude gains on the sale of your business. So again, not going to get into details on that since likely not applicable, but just know that if you happen to be involved in any Section 1202 transactions, benefits have been enhanced. There's been some expanded eligibility. The big one that could potentially come into play for people on the call today, there's a new 1% floor on charitable contribution deductions. So historically, you've always been limited to 10% of your taxable income. So if you have, $1 million taxable income, you can only deduct up to 100,000. And so now we have this new 1% floor that basically says the first 1% is not deductible, period. So 1% of your taxable income. So historically, as long as you were below that 10% threshold, there was really no big deal. And, if you were a little bit over that, you would just carry over to the next year and, deduct it as a charitable contribution carry forward. Now with this 1% floor, you're going to want to make sure you're paying attention to what's running through your charitable contribution expense account. If there's stuff in there that's, really likely sponsorship or marketing expenses, you want to get that out because it's going to be subject to that new 1% floor. So again, if you have, let's say you have 100,000 of income, the first 1,000 of charitable deductions is not going to be deductible, period. And then if you have charitable contributions, it's then subject to that floor again. So it's possible you could have some contributions hit by that floor multiple times. So if you have very minor charitable contributions, it's possible that your contributions are just no longer going to be deductible. But if you have quite a bit running through that account, it's definitely worth taking a look to make sure that everything in there truly is charitable contribution and not, you're not paying for, writing a check at a golf outing and getting your logo posted all over the place and you get, other benefits rather than just writing a check to charity. If you can reclassify some of that to sponsorship or marketing revenue, likely beneficial to do so to get it out of that 1% floor. Not going to spend much time on this. Full disclosure, I am not an international tax expert. This is likely not applicable to most people on the call, maybe not anybody, but just wanted to put it out there in case it is. If you have international operations and you're subject to the BEAT tax, GILTI, you have an FDII deduction or FDII deduction, make sure you're working with your tax advisor to take a look at these changes and see how it affects you. And again, so before I jump into the individual provisions here, I know we're about halfway through time, so I'll move a little quicker through the individual stuff so we can save some time for questions here at the end. But I guess the key takeaway is just make sure that, as you do planning here in the back half of 2025, take into account these changes. If you're calculating taxable income quarterly, it's likely that you have the opportunity for more depreciation expense, maybe more interest expense, and possibly pulling in a lot of unamortized Section 174 costs. So what we're seeing with a lot of our clients is maybe we had some estimated payments in the first 2 quarters, and they probably don't have to pay anything for the second or the second half, the third, fourth quarters, because they've already gotten enough paid in for the first 2 that it covers the year with these additional expenses. So just something to make sure you're taking into account as you do your planning. And then especially when it comes time to putting together your tax provision and start filing tax returns for next year. Better to plan in advance and know what to expect. So with that, we'll switch gears, go a little quicker through this since, this is really meant to be geared towards co-ops. but didn't want to ignore the individual provisions because it was a big piece of the tax bill. A lot of what's in here is really just an extension of the Tax Cuts and Jobs Act. A lot of the individual provisions, unlike the corporate provisions, were set to sunset after 2025. So the tax rates, those have just been made permanent, which is great for pretty much all taxpayers. The personal exemptions, which we had prior to Tax Cuts and Jobs Act, have been permanently repealed, so those aren't coming back. Child tax credit was increased to $2,200 and will now adjust for inflation. So if you have kids, benefit there. And then AMT, prior to Tax Cuts and Jobs Act, quite a few taxpayers were subject to the alternative minimum tax. But a lot of those higher exemption and phase out thresholds have been made permanent. So since Tax Cuts and Jobs Act passed, much fewer taxpayers have been subject to the AMT, and that should be the case going forward. And then just on the premium tax credit, if you happen to get your health insurance through the marketplace and you're getting a premium tax credit, just know that they got rid of the cap on repayment. So it's important to make sure that what you're reporting is your income for the insurance that you qualify is accurate or as accurate as possible, so you don't get hit with an unexpected repayment on your tax return. A few other things: standard deduction, the higher amounts have been made permanent. One change that they did make, and this kind of they basically repealed the P's limitation, which again, I'm not going to get into the details on that, but it was basically a limitation on high earners on how much you could deduct if you itemize your deductions. What they did was they repealed that and they just added this new 35% limit or deduction limitation. So basically, if you're in the 37% tax bracket, you can only get a 35% benefit from your itemized deductions. So it just reduces the benefit there a little bit. Miscellaneous deductions have been permanently suspended. So that was your tax prep fees, unreimbursed employee expenses, and things like that used to be subject to the 2% income limitation. Big thing for individuals is under Tax Cuts and Jobs Act, they implemented a $10,000, what's known as the SALT cap, or state and local tax. So basically, to itemize your taxes, you could only deduct up to $10,000 for state and local taxes. So to make up the difference between your standard deduction and itemized, you had to make it up with mortgage interest and charitable contributions. That cap's been increased to $40,000. So big win for higher tax states, the high income tax states like New York and California. Residents were really impacted by that SALT cap. Still, $40,000 for some taxpayers still isn't going to account for a lot of their taxes, but at least it's enough to get more people up into that itemized deduction territory. So good win there. And then seniors now get an additional $6,000 deduction. This was kind of their way of one of President Trump's other campaign promises was no tax on Social Security. Obviously, that did not make it into the final bill, but they did get this additional deduction for seniors. So it was kind of their way of inadvertently at least lowering the tax liability on Social Security income or just retirement income in general. There are a couple changes to charitable contributions and deductions for individuals. We now have a $1,000 per person. So $1,000 if you're single, $2,000 if you're married filing joint. Above the line deduction. So if you recall during COVID, they kind of temporarily added this to encourage charitable giving. So now that's part of the tax law going forward, that even if you're not itemizing your taxes, you get a deduction for up to $1,000 in charitable. And then they also added, similar to the corporate floor, they added a 0.5% floor on charitable deductions for people who itemize their taxes. So there is going to be a small portion of your charitable that is not deductible, similar to what we saw over on the corporate side. Real quick, one of the biggest things in here for individuals, especially farmers, landowners, they permanently increased an index for inflation, the estate and gift tax threshold. So that's set at 15 million. It was set to sunset after 2025, and it was going to go back to pre-Tax Cuts and Jobs Act. So about $6 or $7 million. So pretty significant here. And now that we have some clarity on what that estate threshold is, makes it a lot easier for long-term estate planning. And it also just allows for much larger transfer of wealth to the next generation through estate planning. I'm sure pretty much everybody's heard of these Trump accounts. So if you have a child who's born in 2025 or later, they'll automatically deposit $1,000 into these Trump accounts, and they can be established for children under the age of 18. Opportunity zones, not going to get too far into the details on this, but so this was around in the original Tax Cuts and Jobs Act. If you have capital gains income, qualified opportunity zones provide an opportunity to, invest in projects that have been identified in these zones that will allow you to defer tax on those gains. And then you get a small bump in your basis. So you do get to actually eliminate a little bit of the gain. So nice tax planning tool if you have some significant capital gains. And just wanted to point out that these are back and made permanent. A couple other Tax Cuts and Jobs Act extenders, the qualified residence interest limitation is in there. And then the 10% floor on qualified disasters has been waived. So if you have if you live in a hurricane, if you live through a hurricane or other natural disaster that's been qualified by the federal government, that 10% casualty loss floor has been waived for those deductions, which is nice. A few other things on here. I'm not going to hit all of these. The one that has been getting a lot of attention, I know here in Ohio, we have legal sports gambling. So historically, you were able to deduct up to 100% of your gambling losses to the extent that you have gambling winnings. There's now a limitation of 90%. So you can no longer offset all of your winnings with losses. And you have to be itemizing your taxes in order to take advantage of that deduction. So it was already somewhat limited, but now you're limited to 90% instead of 100%. So unfortunately, Cleveland Browns fans will now only be able to deduct 90% of their losing tickets. Again, just a couple additional deductions and credits on here. And I can share these slides with the group so everybody has the information. The big one that's gotten a lot of attention is the car loan interest. So that is an above the line deduction, but there's a lot of stipulations on it. The car has to be made in America. And as we've interpreted the way the law reads, that means the final assembly occurs in the United States. So I think there's definitely going to need to be some guidance on truly what that means. But as of right now, that's how it reads: is the final assembly of the vehicle has to occur in the United States. Car has to be new, used for personal purposes. And again, it's an above the line deduction. So even if you're not itemizing, you'd be eligible for that deduction if you meet all the other criteria. So potentially nice benefit there for people who are buying new cars. And then the scholarship granting credits, I just wanted to point that out. So they added a dollar for dollar. It's non-refundable, so you have to have a tax liability in order to take advantage of this. But it's a dollar for dollar credit if you make a charitable contribution to a scholarship granting organization. So it's kind of a nice way to gives you the opportunity to give back kind of on Uncle Sam's dime. Whereas, that money was going to go to your tax liability anyways. So why not write a check to a scholarship granting organization and they get the money instead of the IRS. One thing to note on that is that you do have to reduce it if you live in a state that also gives a credit. So for example, here in Ohio, Ohio does give a smaller credit for checks written to scholarship granting organizations. So if you live in Ohio and you're already taking advantage of that credit, you have to reduce your federal credit by that amount.